Now
Yeah.
I started recording. It's 7 o'clock now.
Okay.
Hello everyone. Good evening. It's time again for our investing discussion group. Before we start, let me give a brief introduction to Kristen Jacks, our speaker. Kristen Jacks is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and the Mutual Fund magazine before becoming a writer and a speaker. Her new book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Today, Kristen will talk about ETF. Now I'm turning this to Kristen. Thank you, Kristen.
Thank you, Young, and thanks as always to Greenwich Library for the great programs they put together. It's really a treat, all the things that you guys do. Okay, so welcome to the Investing Discussion Group. This is actually the 9th webinar of our 2nd season. We do 10 webinars each season, and then we take the summer off, so we don't do July and August. And the theme for this particular season was the best-selling books that will help you reach your financial goals faster. And we've really had a great time covering some terrific books like The Psychology of Money and The Bond King, and The Quants, I think, was the last one we did. That was great. And tonight will be exchange traded funds. Now, if you are interested in any of the other webinars, but you happen to miss them, eventually, not immediately, but eventually they do get loaded onto YouTube and they live there. So if you want something from earlier in the season, that would definitely be there. And if you've never been to the library's YouTube channel, it's easy to find. Just go to YouTube and then in the search bar, put in Greenwich Library. And then this little white rectangle box I have on this slide kind of shows you, you'll see that logo of the library. And click on that and that'll take you to the library's YouTube channel where these webinars live eventually, not right away, but eventually. Okay, so today we're doing exchange traded funds, but also we want you to plan ahead for the 10th final season 2 webinar is June 11th. And we're covering the book Misbehaving by Richard Thaler of University of Chicago. He's pretty much kind of credited with creating behavioral economics. And I just love this topic because Nobel Prize, 3 different Nobel Prize winners can't be wrong that there's a lot more going on in terms of the pricing of securities. It's not all logic. It's not all efficient market hypothesis. And a lot of these Nobel Prize winners really get into the psychology behind what's going on with investments. Young, could you mute? There's just some background noise. So what we do is we mute everyone, but you're always welcome to unmute to ask a question. You're always welcome to put a question in the chat. But in any event, so our final webinar, June 11th, is all about behavioral economics. It's a fun book too. You do not have to read the book, never have to read books in order to participate in the webinars. We just kind of, I read the books, I really pore over them, and then I try to pull out the relevant stuff. But I'm really looking forward to that topic because clearly there's a lot more going on in these volatile markets than just logic. And if you've been following any of the action in the last 2 days, you could, with Roaring Kitty returning to the meme stock world, it's just been incredible. I happen to own some AMC, and I don't remember exactly. It's something like it was up 80% yesterday and 100% today. So that was good for me. But I think that's kind of over. So don't try to jump on tomorrow. But and GameStop, doubled and all these things. So it's almost like, a repeat of the nonsense that happened a few years ago. So clearly there's a lot more going on in the market than just like sober thinking and, stocks being priced at their correct value or anything really, gold, bonds, anything. And so I think the behavioral piece is so interesting. And the behavioral piece is based on research. So all of these researchers are trying to find patterns, right? So it's not just saying people are emotional, it's saying we've looked at all of this data and now we know that there's like a home country bias, for example, or an action bias. So it should be really interesting to kind of get down to the mistake investors make, so that you can make sure you don't make the same mistakes. But also, if you know people might make those mistakes, you could see some opportunities. So I'm really looking forward to that. So that is June 11th. And you can register for the webinar now at the library's website. You just go to the calendar. And oh, final thing, we really, really need your input. So we're wrapping up season 2. Season 3 is going to start next September. We're almost on a school calendar. So we'll start in September. And we have these topics already lined up. So the whole issue of a tax-free retirement has become kind of a hot topic where you should at least know how the experts say you could possibly do it. Very difficult to do in an expensive area like Greenwich. It kind of assumes, you own your house outright, and it's not such a big house that, your taxes are $20,000 a year or whatever. But it's still very fascinating to figure out like how you needed to maneuver and position yourself, starting 20 years before to actually just collect that Social Security check, get some income from your account, that somehow is being, you're accessing that income and it is tax-free because of Roth IRA and other things. I don't want to give it totally away. We're also going to look at the economy because we've never actually done a webinar that's just on the economic indicators. And, certainly if you listen to the financial news, they're always talking about economic indicators and what that means for what might happen with securities prices. So it'll be fun to kind of bring that all together. We always have something on bonds, and I like to, where it's sort of a play on words here with bombshell, to really get into the bonds that where people get burned and they don't expect to get burns because they're burned because there's a myth that bonds are safe. So we're really going to delve into that and make sure you know how to evaluate a bond, how to pick the good ones, avoid the bad ones, or maybe you'll just do bond ETFs after tonight. And then we're going to do how to pick a financial advisor. So we have 4 good ideas lined up, but we really, really want to know what you would like to hear, whether it's college savings, foreign investments, anything. Just think about, what are the kind of burning questions that you have, or how would you like to spend another Tuesday night just learning? So please feel free to, put ideas in the chat, or my email is going to be on here. You can email me. Young could put her email in the chat if you just want to email her directly. Young runs this group on the library side, but we'd really, really love to hear from you. So please participate. And, whether it's, planning for the future or tonight, you can always write in the chat. You could unmute and just talk. We'd love to hear from you. Okay, the big topic, exchange traded funds. And now nobody here is a dummy, but it's, just funny how they have that series. So exchange traded funds for dummies by Russell Wild. And I'm going to do the disclaimer before I get into the book. This webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments mentioned in this discussion group are specifically discouraged or recommended. If you plan to invest, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, so our author, Russell Wild, Exchange Traded Funds for Dummies. Who is Russell Wild? So he's an author of several books, actually. He writes about finance. He also writes about careers. He writes specifically about investments. He has a BA in economics from American University and an MBA from Arizona State. He also passed the Series 65, which is a very, very tough exam about investments and suitability of investments and regulations around investments and all sorts of things, very difficult to pass. Interestingly now, if the regular person tries to take that exam and passes, anyone who passes that exam can participate in investments that usually require you to be an accredited investor. So the law used to be that you had to have, either a high income or a lot of assets outside of just the value of your home. And now they've decided that, the rules was changed so that anyone who's just particularly knowledgeable and can prove their knowledge can participate in kind of much more sophisticated investments that were limited to accredited investors. So the that accredited investor designation, I guess you would say, has been broadened to anyone who passes the Series 65. And finally, Russell Wild is a fee-only financial planner. He's been one for more than 20 years. And the reason fee-only is important is that, financial planners offer investment products, right? So they offer, maybe try this mutual fund or that ETF. And very often financial planners are getting a commission, something from the company that creates the ETFs, creates the mutual funds. And so you can't possibly know if your financial planner is really helping himself, helping herself, or giving you the best possible advice. So the fact that he's a fee-only financial planner means that he's not taking those commissions, or at least he makes that very clear. I mean, I guess someone could be sneaky and do both. So I'm expecting, I believe that his advice in this book was very clear-eyed and that he hasn't been swayed by commissions from asset managers. Okay, so ETFs for dummies. What's in it for you? How can ETFs for dummies help you reach your financial goals faster? So Russell Wild says that ETFs offer many benefits. The benefits are diversification, tax efficiency, low fees, ease of purchase and sale, and then something I'm calling targeting, which I'll explain more later. However, he also points out, and ETFs are a real craze, right? I mean, they've just grown and grown and grown in popularity. He says there are many benefits. He says you have to be careful because of the popularity. There are now all these low quality ETFs that are somewhat indistinguishable from the good ETFs. And if you don't know what to look for, and those low quality ETFs can put you on the wrong path. So we're going to talk about how to find, like, what are you looking for? How would you know if you've got a good one or a bad one? Then Wild also gives excellent asset allocation advice. Is really just a strong part of the book. So very often, people just, people are in America's favorite investment, the S&P 500. Sometimes all people do is like, that and a little something else. Plenty of people ignore bond funds, for a very long time, which they definitely shouldn't be doing now because bonds have come roaring back and bonds really offer like some ballast for the portfolio and some good returns. So we're going to talk about asset allocation because we're going to talk about all these ETFs and they're just so easy to purchase and they're so low cost and tax efficient. And there's so many of them that you could just create like a terrific portfolio, at least minimize some of the mistakes. If you're too heavily concentrated in the large cap stocks, if you're too heavily concentrated like US only, right? If you don't have bonds. So he does a great job of like pushing you into the asset allocation world. And we'll talk about that. And he also does some scenario driven things. So, I won't go into too many of them, but if you ever want to take out this book from the library, I mean, it'd be like, oh, if you have the high tax bracket, then you should do this. If you're in retirement and you want income, then you should do this. So he does a lot of scenario driven things that I think are very valuable. And he's always connecting them back to ETFs. And then beyond the book, just to give context, we definitely need to do a brief history of ETFs. And the reason I have Sorry Canada in there is that one thing that irked me about the book is that Russell Wild was like, hey, everyone thinks that the United States invented ETFs, but Canada got there first. And something about that story did not sit right with me. So I took the time to do a lot of research on the history of ETFs. And I can explain to you why Canada was first to market, but really the United States deserves all the credit. And we're certainly the powerhouse now. Also beyond the book, we're going to look at index investing because that's really kind of like the bedrock of all ETFs is based on index investing. So you're going to want to make sure you know what that is. And then some ETFs kind of go into these, maybe you've heard of factor investing. We should maybe even do a whole thing just on factor investing, but I'll explain what that is. But to understand the ETF universe, you're going to really want to thoroughly understand indexing and then understand these factors. And when you add a factor is really just an attribute, right? So you could have like you're doing a basic index fund like the S&P 500, but then you sort of add this factor of maybe a little bit of value or maybe a little bit of momentum. So I'll explain it more later, but it's called tilting the portfolio. Instead of just doing the pure index without any changes, you can kind of tilt it a little bit toward one of these attributes. And value would be an attribute, momentum would be an attribute. Another thing he didn't mention, which I think is one of the huge benefits of ETFs, is once you have the ETF, which means anyone can purchase it because it's traded during the day, then all of these mutual funds that were off limits because these private investment companies were creating mutual funds and only allowing financial advisors to access the mutual funds for their clients. Well, once you have an ETF, you can't restrict it from being traded. So I think it's amazing. I'm going to give you one company in particular that I've always loved this company. I've always wanted access to this company, but I don't use a financial planner. So I was like, oh, well, darn. But now they've taken their products and they've created ETFs. So their funds, the funds they used to have are now exchange traded. So all you need is the ticker symbol and you can own it too. So that's a real benefit for people if they're savvy enough to know the top asset managers out there that are usually restricted. Then we're going to do a short detour into what I call the 100-year flood territory, because there's always something that could be a little scary about financial products in general, especially sophisticated ones. We remember from the subprime crisis, the huge meltdown in 2008, 2009, because of these mortgage-backed securities that weren't good. Do we always fully trust that the people creating these products are are they working well with regulators? Are they caring about risk? How leveraged are they? So I don't want to say ETFs are always wonderful, everything's great. If you find a good one, go into it. You always have to kind of think about some of the things that might go wrong. And then, of course, we're going to do like a Q&A. And anytime you have questions, you can put them in the chat or mute. Okay, I hope you like this slide. I spent a lot of time on this slide for our brief history, not just of ETFs, but sort of modern investing in the United States in general. If you really want to understand some of the innovations, some of the changes, I just start in the 1970s and imagine, it's the 1970s and stocks are just getting destroyed. So 1973, 1974 were brutal, brutal times. So John Bogle, who started Vanguard, and went to Princeton, started Vanguard, he's a good guy, and he's in this industry where he's not delivering for his clients because stocks are getting crushed. But he also looks at the products that are being offered, the investments that are being offered, and they were all, mutual, not just mutual funds, but not mutual funds the way we think of them, right? So I don't know if you do Vanguard funds or Schwab funds or all these things. There were no discounted mutual funds, right? Charles Schwab, so John Bogle was 1976, the first index fund. He started Vanguard. Charles Schwab was 1975, starting the first discount broker. So when you start in the 1970s, you have like full service, full price brokerage, and they are charging, I couldn't believe this. If you bought an investment, the commission was 8%, right? Can you imagine? Just, it's just inconceivable to me that they were charging 8%, taking 8% of your money right off the top when you went into an investment. And the stock market was doing horribly. And the people who were the asset managers, you did not have a tax shelter. There were no 401ks. Like you're not protecting your money inside a 401k. So when the asset managers, all the funds are actively managed, right? So you have a team of researchers picking stocks, buying some, selling others. That triggers a tax consequence. So now you've got like this perfect storm of horror, right? Expensive commissions, unwanted tax consequences, bad market, like all of these things were happening. So you had actively managed mutual funds, a bad market, high commissions, all this trading that was creating tax consequences, no one being spared. some accusations of over trading called churn. So all sorts of shenanigans and bad things going on. And that's when things started to change, right? So all of this misery gets addressed, and John Bogle is like, well, we could at least lower the funds. Does somebody want to make a comment? Somebody unmuted. You know, or anytime you want to put a question in the chat, that's good too. But so you can see this backdrop of something's got to give, right? This is not a good system. Customers are not being served. So John Bogle was adamant about creating index funds. So getting rid of the whole actively managed idea, because he was like that, the actively managed funds don't do that well anyway, once you account for the high commissions and the tax consequences and of the churn and things like that. So he was full bore, let's just pick, you know, the S&P 500 and full bore, like all we're going to do is try to mirror the market, make the fees low. And so he was a real innovator. And then Charles Schwab was a real innovator with discount brokerage. So that's the 70s leading into the 80s. And you have like this momentum building of like, there should be more passive funds, lower fees. So the mutual funds are going from very expensive, actively managed, not tax efficient, to still mutual funds. We're still just talking about mutual funds. But now all of these indexes are being harnessed, right? So now I'm just gonna jump ahead a little bit so that, you know, when you see index, what I want you to think of is, index is just one of those weird words that it's like, probably has other meanings in other times. But when you see index related to stocks, let's just say stocks for now, but also bonds, I want you to think of groups. You know, there's a grouping or a subgroup, right? So the S&P, oh, did you want to say something? So when you see index, so this is all, we're getting into now the index investing. So forget the actively managed individual stock picking. So mutual funds are moving. Catherine, did you want to say something?
No, thank you. Thank you.
Okay. So we're moving away from the actively managed into the index. And when you see index, just think of groups, right? Like the S&P 500 is a group of the top 500 stocks out of, you know, more than 3,000, right? Or the Russell 2000 is a grouping, a very large grouping of stocks that doesn't include the top 1,000. So it's like if you wanted to get away from the mega caps and the large caps and things like that, you could do that group. Or the FTSE 100, now you're getting into international companies and things like that. So these are just, indexes are built, you know, they're kind of like special companies that build these indexes that are sort of capturing a group or a subgroup. Okay, so now here we are, we're going from away from active, more toward different indexes, and the costs of mutual funds are coming down. But mutual funds still have not problems, but they're, you know, if you're going to innovate, if you're going to have financial products that innovate, you have mutual funds that don't trade during the day. They still have tax consequences, not as bad if they're following an index, but they still have these tax consequences. And then you have in 1987, Black Monday, and that's where that little icon, the little image I said have there, that's panic, right? That's Black Monday, where the market crashed 23% in one day. And there was a lot of fallout from that, a lot of questions about like, how is this market constructed? What was going on? How could something like that happen when it wasn't really an intentional, like, you know, no war started, people didn't wake up and all of a sudden want to pull all their money out of stock. So when the postmortem was figured out on Black Monday, like what happened in 1987 to make stocks go down that much in one day, there was this very complicated discussion of portfolio insurance, and using portfolio insurance relied on the futures market. And it's very, very convoluted, but it's also the birthplace of the ETF, because the innovators and the geniuses who know how to create financial products, they looked at the Securities and Exchange Commission, did a report of like their understanding of why Black Monday happened. And the SEC concluded that this portfolio insurance plus the futures market and the futures market being controlled by the Chicago Board of Trade and not the SEC. These were all these complicating factors, and the SEC was like, what we really need is a basket of stocks, a basket of securities that trades, on the exchange. Has nothing to do with the futures market, that has nothing to do with the exchange. And I know this sounds very complicated, but I'm just trying to give you, this is the true history of the ETF. And two guys at the American Stock Exchange at the time just kind of read this report, and they were like, yeah, we should have that. Like, we should have the S&P 500, which is a common mutual fund, should be able to trade like a stock. It should be a tradable thing. It took them a long time. So you have like 1987, the fallout, the report. The first ETF is not till 1993. It's at the beginning of 1993, and it's it's the S&P 500. It's called a spider because it's the S&P 500 as a depository receipt. So ETFs were not called ETFs at first. They were called depository receipts. And the ticker symbol was SPY, but it's a little confusing because you see SPDR, S&P depository receipt. That's not the ticker, that's the name of the ETF. And nobody called them ETFs, but that's a whole other thing. But there you go, 1993, your first one. But what the heck is it, right? Like, the shorthand that people like to use is, just think of it as a mutual fund that trades like a stock, right? Because it is. I mean, it is like a mutual fund is just sort of like, this basket of securities that doesn't trade like a stock that you can tap into, but you're going to send the mutual fund company your money and they add it at the end of the day, sort of thing. So the shorthand was like, it's a mutual fund that trades like a stock. There's a lot more going on. One thing that's going on, and this is why it's called a depository receipt, is that the ETF itself, the entity itself, when you own an ETF, the way I like to think of it is, if you ever, in winter, if you go to like a nice place and they have a coat check, and you give them your coat, and they give you a claim ticket, right? Do you have your coat? No. Do you have a claim check for your coat? Yes. That's kind of the system that guides ETFs. You don't actually have you're not actually in possession of, let's just say, stocks for now. I mean, the ETFs are everywhere. So you can do commodities, you can do bonds, but let's just say stocks. So if you buy an ETF that is a collection, like a basket of stocks, very similar to a mutual fund, well, the mutual fund actually owns the stocks, right? Like, they own them. They don't have a claim on them, they own them. But an ETF is like a claim on a basket of securities. Now, that used to really freak me out, but obviously the SEC wasn't going to, it took 4 years for the SEC to approve the first ETF. So they wanted to make sure that the custodians and the market makers and all the players that were around creating these ETFs, like, that claim ticket really needed to be good for those underlying assets. Some custodian needed to be holding those assets, and this system needed to work. But it's a difference, right? It's you have an ETF, you have a claim on a basket of securities. You don't actually have the securities, so it's a big difference. And the reason they call it a depository receipt is that this whole concept was based more on how commodities had been traded. So if you were doing soybean, like, you wouldn't actually collect the soybean's in a warehouse, but you have a receipt for the soybean. So it's deposited, the soybeans deposited in a warehouse, and you have a depository receipt. So that's how they came up with the S&P depository receipt. So that's 1993. And then, we're moving along, and year 2000, and all you need to know is ETFs start to become popular. Just like, mutual funds had already been very popular. Overall, the whole market is shifting away from actively managed funds to indexes all over the place. Costs are coming down. And, with electronics, the internet, everything improving, the day trading is ramping up, and we get all the way to now. Okay. All right. So just a little history lesson, because there's some arguments about should everything be passive, should everything be indexing. And I just wanted to read you this part. So this is from my book, which is a very readable version if you're trying to get your feet wet in investing and avoid the jargon and really understand bonds and really understand stocks and ETFs and things like that. I wrote this book just so that all that stuff was just very digestible. So here's the history lesson. The active versus passive debate. So indexes are passive, right? Because you're just buying a whole group. You're not cherry picking. It's time for another history lesson. 50 years ago, John Bogle, the father of index funds, started a revolution. He boldly rescued investors from exorbitant fees and other bad practices like churn, which is unnecessary trading in a portfolio, that harmed investors with costly tax consequences. Index funds brought transparency and low cost to investing. They have boomed in popularity, and Bogle became a hero. This is not hyperbole. Bogle has a huge fan club, the Bogleheads, that produce an excellent podcast and hold an annual conference. But things have gone too far. Many experts advise investors to only use index funds, claiming that selecting individual securities on their merits, i.e. what active fund managers do, doesn't work. Now there is a vocal debate among financial professionals about active versus passive money management. The active camp defends the careful selection of securities, while the passive folks say you can't beat the market, just buy everything in the group or subgroup. This book would double in size if all the pros and cons of active versus passive investing were explored. Suffice it to say that low-cost actively managed funds, because now we have those, have their place, as does individual stock picking. And index funds have flaws. America's favorite investment, the S&P 500 index fund, has a problem because it is usually cap weighted. That might sound a little strange, but like every asset manager under the sun provides an S&P 500 fund. So you have to always find out, is it equal weighted or is it cap weighted? And most of the time it's cap weighted. Investors buy the S&P 500 thinking they are getting a wide variety of America's top companies, but cap-weighted S&P funds favor mega caps. As of this writing, 28% of the Vanguard S&P 500 index fund is only 7 stocks: Apple, Microsoft, Amazon, NVIDIA, Alphabet, Meta, and Berkshire Hathaway. So that's the whole, I don't know if you've heard about this Magnificent Seven, but people laud index funds, and they certainly solved a lot of problems. But now there are also new problems because of cap weighting. So I'm going to give you a little visual here. So I just want you guys, oh, go ahead.
Sorry to interrupt you. There's a question, so I think a good question. In the chat, there's a question that does the claim, you mentioned the claim, against the basket of stocks increase the risk to the owner of the ETF?
So this is the thing, and we're going to talk more about this at the end when I talk about my 100-year flood sort of hyper paranoia. It's just, if you know the mechanics, like it's good to know the mechanics, and then if there are bad actors, if there aren't enough regulators, if the custodians, like it's just kind of an interesting idea, right? Like in an ETF, you're not owning, you don't personally own the underlying securities. You have a claim on them. Now that whole process is supposed to work because they're supposed to be like reputable custodians, and a reputable custodian is open to audit, and we have regulators and all these things. It's just, when we start getting into the really weird ETFs and the really non-liquid ETFs, that's when I pause, right? So and I'm very conservative and semi-paranoid by nature. So it's just something that I wanted you to consider. And we're going to talk more about it when I do the 100-year flood part. Okay, so because ETFs are so heavily based on the idea of an index, I just wanted to make sure, we started with the actively managed mutual funds. They start shifting to all these index funds. I mean, they're mutual funds, but they're based on an index instead of active management. Active management meaning like there's a group of asset managers deciding we're going to buy this stock, not that stock. We think this company's good, not that company. You don't get that with an index, right? With an index, if it's the S&P 500, it's like we're just taking the top 500 companies right now, like that's it. And so companies fall off at the bottom, right? They switch, the companies fall out and new ones get added. But overall, there's not a lot of trading in an index fund. It's just you either make the cut or you don't make the cut. And people think, oh, well, that's great, because now I'm getting, like, say it's the S&P 500, I'm getting, this great distribution of like Eli Lilly and Hershey's and GM and Target and FedEx and Starbucks. And, just looking at those logos makes me feel good. It makes me feel like this is what I really want. But that's not how an index fund works. It's cap weighted. So when it's cap weighted, this is what you get. As certain companies become more and more popular and grow and their market capitalization grows, kind of the rules of the index are you have to buy more of the bigger company and you have to hold less of the smaller company. And then over time, this is what happens. So you end up owning almost no Hartford Insurance or Target or Ford or Kellogg's or FedEx or things like that. And everything gets weighted to these mega companies like Apple and Amazon and Microsoft and Berkshire Hathaway. And a lot of people just don't understand this. So they definitely have problems with being diversified because they think they're diversified, but they're really just very heavy mega cap companies. So understand indexing. You have to understand indexing or you're not going to understand ETFs because ETFs are based on indexing. Okay, so we got the indexing, and then a lot of ETFs have sort of these factors or these tilts. And I just, people get confused with factor investing. Like, what does it mean to have a factor? And it just means instead of just taking the index, whatever the rule for the index is, like let's go back to, say it's the Russell 2000. So take the top 3,000 stocks in the US, get rid of the first 1,000 by market cap, and then the remaining 2,000. So if you want to go more like mid cap and small cap stocks, that's what the Russell 2000 is. Well, that's without any modification. But then factors are a modification, and it's based on research, right? So value, like stocks that are, instead of being growth stocks or overpriced stocks, they're value stocks. Like that's considered a factor. So you might start with the Russell 2000, but tilt, like overweight, look for, do a little bit of actively managing around finding a factor. So a factor is just an attribute. So value is an attribute. Momentum is an attribute. So what is momentum? So I'm just going to use this quote from this chief investment officer who's very smart. He's like, momentum is fascinating. Momentum is something that we observe, but we don't understand why it happens. A security that has extremely bad performance will continue to have, for some short period of time, bad performance. And a security that has extremely good performance will continue to have, for some short period of time, good performance. So if you're going to have like an index, but you're also going to have a factor tilt, you start looking at the stocks within that index. And if they have this momentum, right? Like if one is going straight down, or not even straight down, it could just be petering out, like just kind of slowly losing it, day after day after day. Well, that's considered a momentum issue. So it's like, don't have much of that stock because the research in the past has shown that as stocks start to sort of decline that way, they continue to decline. So it's like, oh, well, let's maybe make, we're going to have an index, but we're going to tweak it a little bit. And on, the reverse is we have this index, but if we start to notice certain stocks that they just keep gradually getting better and better and better and better and, more and more valuable, then we're going to overweight and own more of those stocks. So it's kind of mixing two things. It's like the index plus a little active management around a factor. And a factor is just an attribute like value or quality or momentum. So if you're going to understand ETFs, you're going to want to understand index plus factors. Okay. All right. So what are these benefits of ETFs? So hopefully now, you understand that an ETF, the shorthand people will just say, oh, it's like a mutual fund that trades on the exchange. But now we're going to find out Eric Balkunis, who at Bloomberg is like the expert on ETFs, he likes to say that ETFs were like several evolutionary steps ahead of mutual funds because they kind of took the mutual fund model and then they fixed some things and just had some good luck on some things. And so what an ETF does, just like a mutual fund, right? So this is nothing new, diversification, right? So the reason people went into mutual funds is that, especially in a 401k plan, you can put just $100 a month into a mutual fund that gives you exposure to like many, 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 many stocks, right? So, but you could never buy on your own, even with Schwab slices, which I've actually tried. It was really interesting. Even now when they will give you like a sliver of a stock, well, Schwab will say like, go ahead and pick 10 stocks, give us $100 and we'll give you a sliver of each of those stocks. It's sort of almost like build your own mutual fund. But you still we're relying on mutual funds and ETFs for it's just easy diversification, right? Then there's tax efficiency. So big surprise, happy accident. I was listening to a podcast that one of the founding lawyers, securities lawyers who was working on the first ETF, she said they kind of stumbled on it by accident. I mean, in a mutual fund, if there are, for example, redemptions, right? So a mutual fund, it's mutual. It's like many people coming together to pool their money to create a fund, right? And then something happens, some catalyst, and people panic, and some percentage of the group wants their money back. Well, the only way that the mutual fund, so they're redeeming, their money from the mutual fund. There are redemptions. So the only way a mutual fund manager can handle that is the mutual fund manager has to sell, right? And selling creates a tax consequence. Now, it's a tax consequence shared by all the people in the fund, which is kind of odd because there are people who did not want to sell. They're just sitting there. They're kind of impacted by the behavior of the other people in the mutual fund. And it's the other people in the mutual fund that are creating the tax consequence, but the tax consequence is distributed across to everybody. So there's a capital gain or a capital loss for everybody. The way ETFs are constructed, and this is really complicated, right? So we're back to our, like an ETF, you have like the claim check. You don't actually own the securities. You own, a claim on the securities. Well, if you really want to get complicated, how could an ETF that is just like a mutual fund that trades during the day have better tax efficiency than an actual mutual fund? And anyone who's interested, you can email me. I will send you the podcast that explains it. It is not easy to understand, but because of sort of the unique features of an ETF, they say that these things that go on in the ETF are an in-kind exchange that does not create a tax consequence. So when a mutual fund has sellers and redemptions and things like that, it does create a tax consequence. When an ETF has sales, it creates an in-kind exchange. It's very complicated. And so complicated that the lawyers that were putting the ETF together didn't expect this to happen. It was just sort of a happy accident. They found out that an ETF is more tax efficient. Now, this is not a big deal when the ETF is just tracking a large index, right? Because a large index doesn't have a lot of trading no matter what. But it is a big deal when the mutual fund is kind of complicated or the ETF is kind of complicated, sort of a smaller segment of the market or more esoteric. That's where you get into somewhat dramatic differences in the tax efficiency, right? So if you're holding investments outside of, outside of an IRA, outside of a 401k, you're going to want, something that's more tax efficient. And right now, that's the ETF. So for every mutual fund, basically, you can find the ETF version of the mutual fund, very often from the same company. So, this is why people like ETFs. So you've got the diversification, very similar to mutual funds, but now you have tax efficiency, better tax efficiency, really popular. You also very often have low fees, and this is surprising, right? It didn't start out this way. The spider from 1993, the very first ETF did not have such low fees, but a lot of there are so many really, really good ETFs out there that track, an index that you'd want to be in, like a FTSE 100 or a Russell 2000 or things like that. And they cost almost nothing, right? So if you have a brokerage account, almost all brokers now are, no commission trades, right? So you buy an ETF just the way you buy a stock. So that would be no commission, unless I don't know who you're using if you're still paying commissions. I certainly don't pay commissions. So it doesn't cost you anything to buy the ETF. And then the fees within the ETF are really, really, really tiny. So like they should be like 0.1%, not 1%, 0.1% or less. So these are all these great features, right? The diversification, the tax efficiency, the low fees, the ease of purchase, and then this targeting is just that kind of anything you can imagine has been, anything that like you're really, really interested in. So maybe you're just interested in oil and gas companies, right? There's going to be an ETF for that. So any segment of the market you're interested in, I've seen all sorts of things. Like now people are worried that there's way too much emphasis in the S&P 500 on information technology, right? It's like it's all too much of the Apples and Microsofts and things like that. So now you can buy an ETF that's the S&P 500 X information technology. So it's like just get rid of all, a lot of the Magnificent Seven are those companies, and get rid of that whole problem of them being these just dominating the S&P, because you can buy an ETF that's the S&P 500 without those. So there's all this targeting that goes on. And there's even a podcast, it's so funny, where all these guys do every day is just talk about a new ETF. It's like 15 minutes of like my favorite new ETF. So there are all of these ideas out there. So you can easily kind of get into some segment of the market that you think you're interested in or you need. And for low fees, easy to purchase, easy to sell, tax efficient. So this is why people love ETFs. Okay, but low quality ETFs, right? Of course this happens, right? Any product that becomes hugely popular, you get the cheap knockoffs, right? So this is a buyer beware. And in the financial world, so few people have even like a basic understanding of finance that you start to get, some really bad actors out there. They know they're selling you something where the fees are too high. They know that they're selling you something that has poor portfolio construction. So I'll let Russell Wild tell you. So the author of ETF for Dummies, he comes right out and says, many of the newest ETFs are bad investments, pure and simple. They were introduced to take advantage of the popularity of ETFs. They are overly expensive and they represent foolish indices, extremely small segments of the market, or indices constructed by using highly questionable methodologies, right? So I, off the top of my head, can think of some that I can't stand, but I will not mention them because you know what these these ETF creators have? Lawyers, right? So you're not going to catch me on tape saying, what's a really bad ETF is this one. But I'm going to give you an example. So these themes, right? These ETF themes, right? I mean, it sounds kind of nice, but really for so many people, it's just trying to like capture people who don't understand investing and they don't understand that they could easily find like, say you do really care about the environment, right? Say you do like care about that, like bees are dying and we're losing our pollinators and things like that. Someone's going to create an ETF that's like BEE and charge you a fortune for it and say that like everything in this ETF, that it's just representing companies that are saving the planet, right? But the truth is they're not doing that. They're just marketers trying to make a buck. So they're throwing together a few, companies that maybe care about the planet a little, who cares? They don't manage it carefully. They charge you a fortune for it. So it's just marketing, right? So I had this example of KEG, like KEG, right? I checked. There's nothing like if you put that in a stock screener, there is no KEG. So I'm just doing this sort of a fictitious way. So you can imagine with like the whole craft brewer phrase and things like that. It's like someone would create like the craft brewer ETF, and the ticker would be something fun like KEG. And you think, oh, well, I'm really interested in that segment of the market. I believe that could be a growth segment, the way like Starbucks and coffee was a growth segment. Well, whoever is doing that, they're not really trying to help you. They know it's kind of catchy. They know it's good marketing. And then if you buy into it, they're going to charge you outrageous fees. And they're not really doing a very good job of making sure that they have like a good distribution of the best craft brewers and things like that. So this is what's going on with a lot of ETFs today. If they seem catchy, if they seem to have like some neat theme that just sounds cool, buyer beware. Like that's mostly marketing. And so when you go to look for ETFs, I mean, there'd have to be a really, really good reason why you would go anywhere near an ETF that has a fee like even 0.2%, right? Like I draw the line, right? So a lot of these ETFs are going to be like, almost 1% fee or, 0.7% fee. That's a lot of money, believe it or not. It doesn't sound like it, but when you have these fees, you have to think of it this way. Say you have an investment that after a year, it makes 5%, right? But the fee is 1%. Well, that's 20% of your profit, right? So that's how these fees work. So they really, really do matter. So ETFs are great, but the marketers, the bad actors, the people who want to make a quick buck are in this as well. So just beware. Okay, back to the happy stuff. Russell Wild in ETFs for Dummies does an excellent job on asset allocation. Let me just take this quick chat question. Good point. Morningstar has rankings for ETFs as
Hey,
well
Kristen,
as mutual funds.
sorry to interrupt. I just tried to post the link. Morningstar has, people know it's good. It's well known for its ranking for its performance for mutual fund. It also has for ETF. So you mentioned here low quality ETF can put you on the wrong path, but how do I know which one is good, which one is bad? So I would suggest using Morningstar. And
That's a great
you
idea.
have our library subscribe this database. You can have remote access to this database if you have a Greenwich Library card.
Yes, I love the library has so many good databases. I use them all the time.
So I put the link to the how to access to this.
Oh, perfect. Thank you so much, Young.
Yeah.
So I mean, I trust Morningstar. They're not going to recommend any of these nonsense low quality ETFs. So that's a great suggestion. Okay, so Russell Wild in this book gives excellent asset allocation advice, and people are really usually very guilty of not distributing their assets broadly enough, right? So it's like, oh, I've got the S&P 500, I'm diversified. Well, here's this style box. This is from his book. I love this style box. Hopefully you can see it, where he's taking this square and he's putting it into 9 sub-squares where you have large cap value, large cap blend, large cap growth. Now, if you're in an S&P 500, you've definitely got large cap. You don't know if you have value or growth. It's just the top S&P 500, but you definitely don't have any mid cap, none. You definitely don't have any small cap, none, right? So if you're walking around and you're just in the S&P 500, you have not, you're in America's favorite investment, but you are really not diversified. So this is from his book. The more colorful, it's so funny because Young just mentioned Morningstar. This little colorful, smaller box is right off of the Morningstar homepage, where they kind of take this style box and then they tell you day to day, like how each segment is doing. So this is a very popular idea of like, don't just be in large cap companies, right? You want to be in mid cap companies, you want to be in small cap companies. You want value, you want growth. So it's just really kind of expanding your understanding of like, where are all of my investments? And there's this perception that value and growth are totally different. So that's not entirely true. So the reality is more that you can have a value stock that is also growing, right? So like, for example, a long time ago, Coinbase was a growth stock, but it really had, not in the last 6 months, but it really had this tremendous value because of the future cash flows of the company. Like the future for the company was so bright that the trading cost of Coinbase was actually pretty low. So it's not always mutually exclusive. So, and value doesn't always just mean like, low priced, right? Because it's not necessarily a value if it has a low price for a good reason, because it's actually like not a good company. So really value is about something. A value stock is something that's trading for lower than its real worth, let's say, okay? Like sort of an, diamond in the rough. Okay, so we have just domestically, you have large cap value, large cap blend, large cap growth, then mid cap value blend growth, then small cap value blend growth. And in this book, he walks you through like an ETF for everything, in every style box, there's an ETF, right? So that's the great thing about this book, is he's always linking it back to ETFs that you could consider. Then he goes on to talk about how, Americans especially are so country biased, right? We just have this home country bias. But I thought this was so interesting. This actually, I didn't get out of his book, but this was sort of the gist of what he was saying, but I found a better graphic. A lot of people would not think, if you thought about like the top performing stock markets, I have a home country bias. I think of the United States. Well, it's like, well, no, in 2021, Austria had the best stock market. We came in third. In 2020, we were fourth. Denmark and the Netherlands were first, second, and Sweden was third. In 2019, New Zealand, Ireland beat us. I mean, there are all these places, Israel and Ireland and New Zealand and Austria and Canada and all of these places that have thriving companies and stock markets and things like that. And we just tend to ignore them. And that's not good diversification, right? Because, this is where you live, this is where you work. And then if these are all the assets you own, that's not the best diversification. So Russell Wilde does a really good job of like expand your mind. And then he takes every possible scenario, right? Emerging markets or Europe or this. And he's like, and here's a low cost ETF where you can have a good, you can be very diversified in that region, right? If you're interested in that region. So I really recommend his approach to like, expand your mind, expand your reach, and then here's the low cost solution ETF. And I just threw in some of these companies, just keep in mind, I mean, sometimes we forget, like, these aren't American companies. These are huge, great companies, and they're not American companies. So there are all these ways to use ETFs to just really broaden your diversification, which is super, super important. Does anybody have any questions or comments? I'm talking your ear off. It's almost 8 o'clock. I'm just going to keep going, but it's great that you're putting questions in the chat. That's good too, but you can always unmute or just add questions to the chat. All right, so then an unmentioned benefit, so kind of getting beyond his book, but I loved his book. When I was reading it, it really made me think of, as I started studying finance, and I realized that the University of Chicago, the brain power at the University of Chicago, the theories coming out of the University of Chicago was so impressive to me. And then you have some of the graduates of University of Chicago starting financial companies. So one in particular, drum roll please, dimensional funds. So the Booth School at UChicago, the business school at UChicago used to not be called the Booth School. It is called the Booth School because one of their graduates started a financial company, an asset management company, and he did so well that he was able to give an enormous gift to UChicago. So David Booth did that, and now that's why it's called the Booth School. Well, I always loved what David Booth was up to and all the things that he figured out, but I could never participate in his funds because I don't use a financial planner. And so he runs this asset company that is constantly outperforming benchmarks, constantly. It's really unusual, really, really hard to do. But you can't participate. You can't put your money with Dimensional because unless you have a financial advisor. Well, then these ETFs come around and I'm like, well, wait a second. Then I can have my money with Dimensional because they can't keep me out of the stock exchange. I mean, they can't have something trading on the exchange and say, oh yeah, but Kristen Jacks can't buy it, right? So I was like, wait a second. Now with ETFs, these companies that have great performance that used to be off limits, I can get in through an ETF. And so just for fun, I was like, maybe they can keep me out. So I actually, in preparation for this webinar, went on my Schwab account and I bought myself the DFCF, the Dimensional Core Fixed Fund. Anyway, it's fixed income. I was so happy. I'm like, I am now an owner of a Dimensional fund. And yeah, it took me like 30 seconds, which is great because it's just like trading a stock. And there was no restriction. There was no commission. You know, I can own it, you can own it. So that's a real benefit to these ETFs now. And then also, you know, I had mentioned that Russell Weil did a great job being scenario driven with his advice. So what you're going to get out of this book is everything that he mentions, he then says, he gives you like 5 or 6 ETFs that would solve that problem. He tries to distribute them pretty evenly over like, you know, this is a Vanguard ETF, that's a Schwab ETF, this is a BlackRock ETF, this is a State Street ETF. He clearly, I mean, everyone clearly loves Vanguard, right? Because Vanguard does such a good job with low cost, but he really tries to go beyond and name a lot of companies that could solve your problems for you. And he's also done his research so that he's saying like, you know, at least at the time, these were the expenses, right? But you should always check because all of these ETFs are so transparent. If you put in their ticker symbol and you look it up, I prefer Yahoo Finance, but you just take the ticker symbol, you look it up. Yahoo Finance will tell you what its current expense ratio is. And again, all these expense ratios should be super, super low. The only exception is when you start to get into foreign stocks. But even then, if you're just dealing with Europe, I mean, that should not be much at all. But if you're getting into emerging markets like India and things like that, then you should start to have some expenses, but never, never a full percentage point. It should always be lower than that. And then another caveat is when you start to get into foreign funds, you need to be sensitive to the tax consequences. So if you can, try to do your foreign investing. Well, no, I'm not going to say that because I think the tax, you're just going to get hit by the taxes, but it doesn't come at you personally. It's just it's an expense to the fund. I was going to say have it in a tax sheltered account, but that doesn't really make any sense. It's just that, you know, foreign governments want their taxes and our government wants our taxes. And so that's just something to keep in mind, but it wouldn't matter if you have it in a tax shelter. Okay, so these scenario driven advice, you know, whatever your scenario is, if you want income from retirement or you have a very high tax bracket, he kind of breaks those down too, which I think was like a super, super help. Okay, so now we're getting into like my short detour into the 100-year flood territory. You know, if not that it would be fresh in your mind, but the subprime catastrophe of 2008, 2009, and the fact that these mortgage-backed securities that had been turned into unusual new securities turned out to be worthless, even though they had AAA ratings, right? So here you have like the creation of innovative financial products that are supposedly being regulated, and you have like the best big banks in the world that are buying and selling them, and you know, that turned out to be a disaster. So anytime there's a new product, right? Like you have these ETFs and it's like, okay, it's an ETF and it's unusual. And it took the Securities and Exchange Commission 4 years to approve it. And the creation redemption feature is hard to explain, and the in-kind exchange and why it's more tax efficient. It's all very confusing and it's very hard to explain. So are we absolutely sure that the right people who are supposed to be taking care of us, protecting us, are there enough regulators, right? Are there enough people watching what's going on? Now, would I ever lose sleep over a Vanguard ETF of a big index? No, right? Like that's not what I'm talking about. But now you have these really funky ETFs that I'm not exaggerating when I say that there might be an ETF that has a ticker symbol, of KEG to follow like the beer companies, or BEE to follow the pollinators. I mean, there's an ETF for almost everything. And some of these ETFs are getting really unusual, right? Like they might be covering parts of the bond market that are really illiquid. And so there is like my little antenna, my little radar is up. Are we sure that nothing could go wrong? And I've listened to YouTube videos of knowledgeable people saying that they in particular don't have 100% good feeling about the ETFs that cover the illiquid part of the bond market, right? So, I mean, if you're in an ETF that's like government, the government stuff, like the treasuries, or even like the Fannie Mae type stuff, the mortgage-backed securities, the government stuff. Okay, if it's highly liquid, if there's a lot of it, if it trades a lot, I mean, that's not the stuff I would panic on. I would just be like, who am I buying this ETF from? Like, who's creating this ETF? And what are the holdings? And do the holdings really make sense, right? So when you start getting into high yield bonds of kind of shaky companies, small companies, I mean, that's when it just starts to get a little weird. So I don't know. I mean, no one, well, not no one predicted the subprime mess. The Big Short was one of my favorite movies, actually, where clearly a bunch of very smart people predicted the short prime, the subprime mess. But underneath that, there were these financial products that turned out to be toxic. And maybe there's a segment of the ETF world that will turn out to be toxic. I mean, it wouldn't shock me. So again, like buyer beware, who are you buying from? What basket of securities does it represent? I would just stick with things that are highly, highly liquid from very reputable companies. That's my 2 cents. Okay, all right. So any questions? We are at 8:08. I've been talking for more than an hour. I'm amazed you guys are still here. Gotta remind you again, our last book of the season is Misbehaving. Can't wait. The Making of Behavioral Economics. So if anybody has any questions, I highly, highly recommend exchange traded funds for dummies. I'm going to be returning my copy to the library. And like I said, at the end of every chapter, he then lists a whole bunch of exchange traded funds saying like, everything I just described, this is an ETF that would solve that problem, right? And then he'll give you like 7 or 8 examples. I don't like to call out specific ETFs because I don't want to favor one company over the other. But especially for the foreign stuff, I think like you'd be really well served to learn some of the ETFs that he recommends, because he ferrets out like get your exposure to foreign and at the lowest possible fee. So I think this book has been, hugely worth it. One question in the chat. Yeah. Can you explain again of access to off-limit products? Okay, I know this sounds confusing, but there are certain asset managers that I hugely admire, right? And some of the best, so this is not index, right? So we're not talking about an index fund. We're talking about really, really brainy people from some of the best business schools that come out and they, like think of almost like a hedge fund, right? Like Seth Klarman, who is one of like my favorite asset managers of all time. Like I can't get into his hedge fund. So he's going out there he has this team of brilliant people looking at every possible investment, and he's getting into things that are he's just brilliant, and he is a brilliant moneymaker. But I can't invest with him, right? So Seth Klarman is a genius, but he only takes money from the, you know, the biggest institutions, right? So you have like college endowments, like the Yale endowment. I don't know that Yale is actually, uses Seth Klarman. So Seth Klarman's at the Baupost Group, but I'm not sure that Yale is actually a customer. But some of the very best asset managers will not take your money because they don't have to, because they're the best. And so like Harvard or Yale, the endowments that insure the top insurance companies, like these companies that sit on a lot of money and have to have it grow, the big, California pensions and things like that, they get access to these best asset managers. So usually when I discover like a great asset manager, you can't get anywhere near them, even when it was more retail, right? Like even when it was just like the Fidelity Magellan Fund, at a certain point, it's like the fund gets too big and they close it. So anytime there's success, you just can't get near it. Well, with these ETFs, I started to notice that some of the fund managers that I really admire, I could, right? So they created an ETF. Well, you can't restrict access to an ETF. It's trading on an exchange. I know this is hard to explain, but like Dimensional Funds is a company that I super, super admire. And I could not give them my money to manage because I don't work with a financial advisor. And that would be the minimum, is that your financial advisor would get you in to the asset manager. Well, once an asset manager creates an ETF, then anybody can buy into it. So Dimensional Funds, I mean, I'm actually going to spend a lot of time looking at all of their ETF offerings because it's kind of cool to realize that I have access to all that brain power, all of that track record. Dimensional Funds has this amazing track record. And now that they have ETFs, I can just buy into what they are doing. And these are not indexes, right? These are actively managed funds that I now have access to. I know it's just hard to explain, but trust me, it's a good thing. It's, yeah, it's like getting access to the smartest people who usually don't want to help you with your money. Any other questions? You're welcome. Thank you for joining. All right, going once, going twice. We hope to see you June 11th. And we also really, really, really want to know what you want to hear about next year. So please consider giving us some feedback. That would be great.
Yeah, any suggestions, topics, you can email either Kristen or email to me. I'll put my email here.
So here's my email at the bottom, kjacks@moneyinyour20s.com. And Young, so Young Wong is YWANG at greenwichlibrary.org. So she just put that in the chat, but I know the chat's going to disappear. Or actually, I think when people watch this on tape, I don't know that they can see the chat. So it's
I don't think so.
Yeah, YWANG. So Young Wong it's the Y from Young, and then Wong is WANG. So YWANG at greenwichlibrary.org.
And I also want to apologize for one thing. Many people have problem to access to link to today's program. It's because our Zoom account had a problem, had a bug. We created a program at least 6 months ago in Zoom, but today when I got to work, I found Zoom automatically removed the program from the upcoming meetings on Zoom account. So I had to recreate a new meeting for today, for this program today, and I sent the Zoom link to everyone who registered, because we use another app called LeapCal to manage our program, our registration. So I have all your registration email. I send a link to everyone this afternoon around 2 o'clock ish. But I think at least 10 people, they didn't check. They probably just used the old link they cannot access because Zoom
Oh,
delete
I
the
see.
program, so the link doesn't exist anymore. That's why I resend it this afternoon.
Well, so maybe when this is done and there, there can access it on YouTube, anyone who
Yeah,
signed up, maybe we could just send
yeah,
them.
I think right after this meeting, take about 10-15 minutes. Zoom would have finished, transfer the recording from the cloud to the computer, and then I'll send the link and the passcode to this video to everyone who registered for this program. So it's really important you register for the program. Even if you cannot come in for today, you register, you will receive a link for the recording. Right. And maybe a week later, our PR, public relation office, would launch the video to the library YouTube channel.
Right.
Okay,
Okay, perfect.
I apologize for the inconvenience, but always check the email. Check the email before you log in. If there's
Gotcha.
any problem, I will send you the new link.
Okay. All right. Thank you, Young.
Oh, thank you.
Thanks,
Kristen.
everyone.
Thank you, everyone, for coming, and I hope to hear from you about your suggestion for the next year's discussion group. Thank you, and have a good evening. Bye-bye.